Everybody, welcome to the morning market briefing. It's Wednesday, May 11th, 2022. Hope you're doing well out there. Lots to talk about today. We do have some economic data as it relates to inflation and CPI coming in hot off the press. We will get to that here momentarily, but we're going to open up, picking up Philip Morris, buying Swedish Match. It's going to be for $10.56 per share, a 39.4% premium. Philip Morris really trying to get into the smoke-free products. Last year generated 30% of their revenue from that segment. If you go back a couple of years ago, in 2015, they had 0% of revenue there. So obviously a push to get into Zyn and other products like that from Swedish Match. We touched on this yesterday, kind of shaking out as we expected it to. Maybe the premium moved just a little bit. But Tom, you're a user of Swedish Match products. Good acquisition?
I think so. I think everybody knows that, particularly in the US, cigarette consumption is going the way of the caribou. And I think this is a way for them to kind of transition into what has become the most popular form of nicotine use, especially in, I would say,
cool people.
Yeah, cool people, Marietta men between the ages of 32 and 36 that work at Narwhal. But I think it's, the thing is, they're in Sweden. Philip Morris primarily operates outside of the US. They've made a big push to do the IQOS, which was a warmed tobacco product where they basically, it's like a cigarette, but it never actually caught on fire. You just kind of warmed it to release the nicotine. And that was a major flop. It has been for a couple of years now. So I think this is an interesting way to push into something that's already pretty acceptable in, the Nordic region. It's the most popular form of nicotine in Finland and Norway and Sweden. And kind of bring that across, all of their octopus arms they have all over the world. Indonesia is a big place for cigarettes for them. And I think they've also rolled out, I know that Altria Group, which is basically their weird American twin brother that they share a lot of stuff with, has pushed to make On, which is a competitor of Zyn that, as far as I know, has had zero uptake. So by bringing this, by bringing Zyn into the fold, rolling it out with a much bigger marketing budget and a much bigger army of lobbyists, they can push it out. Because I know there was some pushback in San Francisco last year about having flavored nicotine products, but they were temporarily exempt because they don't actually contain tobacco. So I think it's interesting, but I think it's a way for them to kind of push through. Or, counterpoint, they could do what they did to what's the stupid vape thing that everybody loved? The Juul. Yeah, they bought Juul, and then Altria Group bought Juul, and everyone thought, man, that's awesome. They're going to take over Juul and make it, a healthy way of alternative to smoking. And then they absolutely squashed Juul. They basically bought it and then ate it and then threw it in the trash.
And pushed people right back to cigarettes.
So could go one of two ways. So it is possible that they're going to take Zyn in and then just absolutely crush it and then make everybody buy their lower quality alternative.
Yeah, it's an interesting move. I think it's a good move for them. Not that we're necessarily pro cigarette companies, but they've got to stay agile. They've got to find a way to, kind of remain in the marketplace. And certainly the decline in cigarettes has been very, very strongly felt by those companies. Tom, we've talked a good bit about a lack of liquidity. Talk to us about junk credit spreads.
So we're seeing just a blowout in, spreads really across the board, but junk in particular has widened quite a bit. So back sort of before the turn of the year, we were at historically tight credit spreads. Typically, if you're going to be buying a junk bond, you're going to be wanting to get paid quite a bit of money to do that because you're taking the risk of the fact that your investment might go to zero. If you're in higher credit quality stuff, for the most part, your risk is very low, and so you get paid very low. But we're finally starting to see, with liquidity sort of exiting the market, those junk spreads really, really widen. And so they moved from about 250 basis points. So if you bought a treasury, you would get, call it 100 basis points. If you bought a junk bond, you'd get 350 or 3.5% annually. That's moved all the way up to 5.5%. And they're still very low. And I still wouldn't say that there's a ton of value there. There are certain names that we like more on they've been miscredit. Now credit analysis is weak on them, and we think they're actually higher credit quality than they are. And that would be the space we would jump in that space. But if things go kind of the way they did in 2008, at that point you could get, double digit spreads, like upwards of 17%. And so I would say that's I would say there's landmines there for sure. And if, you're looking to take on some risk, I wouldn't say that's the way to do it. I mean, you can basically get the same returns now tax free on munis, and the credit quality is actually going up. And so something to definitely take the foot off the gas if you think, man, we really need some yield. I'd say move into some cleaner stuff and avoid junk. But I think junk is going to continue to just free fall at least until we see some sort of liquidity return to the market.
Yeah, I think you're going to continue to see that struggle, and in theory, what you want is money rolling off that you can reinvest at higher rates. As rates move and things become more difficult for these companies, it's hard to see an opportunity to where you jump in and you say, hey, you know what? Party city debt now looks attractive.
Yeah.
They're so levered. They need to continue to raise money in order to even remain in business. They're probably going under. That's just not going to be an opportunity you want to take.
Yeah. Party City has, I think, taken the lead in the, what used to be the Toys R Us, JCPenney, most likely to go bankrupt in the next 5 years company. So we'll see it. We'll probably hear a lot about it for 2 or 3 years, and then it will go away. Just like those other companies, Radio Shack, you name it. But I think Party City is that company now.
Continuing to see blood in the streets with some of these meme stocks. Unity Software down 23%. Gave just an absolutely horrendous revenue guide. This is a very aggressive, growth-oriented company in theory. People were expecting 360 million in revenue. They've come out and said 290 to 295 million. Having a real hard time monetizing. They're only posting 7% year-over-year growth. The stock's down, about 23%, 26% pre-market trading. I mean, for context on this, not a stock that you probably follow real closely, but it's been as high as $210 in the last year. It's at $35.40 right now. Coinbase really struggling right alongside crypto. A lot of people have viewed Coinbase as a way to potentially play kind of a diversified crypto strategy, because that is kind of their MO. They're a marketplace for cryptos, down 18% pre-market. Stock's trading at $59.65. It was as high as $370 in the last year.
Yeah, we're seeing the bubble burst for a lot of these crypto names. I think we've talked about a lot in the NFT world. We've also talked a lot about it in Bitcoin, but there's real wealth that's being destroyed. I didn't appreciate the size, for example, of this Terra USD. This is a stable coin. We talked about it yesterday about it breaking the buck, and that was significant. Terra USD is supposed to peg to the US dollar, but instead of pegging to the US dollar because it's backed by treasuries or other dollar denominated instruments, it's backed by algorithms. And the problem is these algorithms were proven to be phony, and now it's 2 cents. So you just saw a total wipeout. This was a stable coin with about $18-20 billion in total value. And you've basically just seen a complete wipeout. So think about a $20 billion company. It's probably 8 party cities gone.
Yeah. 40% of GM, half of Twitter, just gone in a day.
So that's what we're talking about in terms of these blowups in crypto. And it's definitely something to be aware of, especially the wealth effect as it relates to some of the new money that we've seen over the last couple of years.
Yeah, it's a wild theme. And I think something to kind of, it's a bit of a cautionary tale. I mean, I think, I know the three of us have been pretty out on crypto. We've been pretty vocal about that. A lot of our thesis has been tied to there's really no store of value with any of these things. And that's very much coming to fruition as we have Bitcoin down today, yet again, down in the $30,000 range. And that's the most stable. You're talking about something that's supposed to be a protective investment that stores value being down, over 50% from highs. It ain't working. CPI, let's jump in. We got that data about 10 minutes ago. On the headline number, people were looking for a 0.2% read month over month, 8.1% year over year. Excluding food and energy, people were looking for 0.4% month over month, 6% year over year. Tom, I think you've got some data in front of you. Where do we come out?
So the year over year number, we came in a little hot, 8.3 versus an expectation of 8.1. The ex food and energy month over month, the expectation 0.4, we came in at 0.6. And so we're seeing quite a bit of red in the bond market today, right away. As soon as that number came out, we had seen a huge push into bonds yesterday. The 10-year fell from 315 all the way down to about 292 before the market opened, and we're all the way back over 3% now. So it's definitely a negative reaction from the bond market. The futures look like they're still holding strong, up about 1% or so, depending on which index you're looking at. The big takeaways, I think, there was some progress. Gasoline came down quite a bit, but you can see some of the places where we are starting to see upticks as opposed to downticks. There's a big uptick in piped gas service. So natural gas into the home was up 3.1%. In the previous month, it was up 0.6. Transportation services ticked up 3.1 as well, up from 2. Everything else was pretty stable, though. There was a very small tick down in used cars and trucks. That's a number we've looked at quite a bit. We saw massive deceleration in March, down 3.8, but in April it was only down 0.4. And so I think there were a lot of people expecting that number to be lower. I think we were expecting that number to be lower on the used cars. But again, this is still a little bit backward looking. And, Ben, jump in here on your thoughts as well. But
the used car thing, I think that the common consensus was that it would be lower. I think based on the Manheim Used Vehicle Value Index that we had from April, I think that's probably a little bit more in line. I do expect more declines in used vehicle values in the future, but we're seeing Toyota reported last night saying they can't get materials and their profit's going to be crunched. So there's going to be fewer new cars out, which is going to continue to keep these used car prices up. What sticks out to me is we're seeing a lot stickier inflation here than I think the market had anticipated. Everyone had been talking about a peak, and last month was 8.5. This month we were 8.3. So technically, I guess you could argue that March was a peak if we continue this trend. I think the trend, though, downward is going to be slower than I think even the Fed anticipates. I mean, if we go down 0.2 points a month from this level, it's going to be a long road to hoe to get back to anything close to the 2% level that the Federal Reserve wants, which means that I actually think that we continue to set the stage for more Fed increases. Now, the comps begin to get easier in terms of, I think that the year-over-year comparisons in inflation may actually come down relatively quickly over the next 2 months. But after that, we're seeing tremendous month-over-month inflation, which is going to take a year to work out at the very least. And we're seeing it really stick. So let's just go through a couple of the numbers. Shelter was up 5.1%. That continues to go up every month. Rent up 0.6%. Owner's equivalent rent up 0.5% on a month-over-month basis. So if you annualize that, you're talking 7.5% on rent and over 6% on owner's equivalent rent, which, I think may still be undercounted. So shelter going up 5%. That's not going to come down rapidly. Transportation up 8.5, as Tom mentioned. What's notable here is that airline fares were up 18.6%. That's not a year-over-year number. That's a month-over-month number. Annualized, you're talking 200%. You're talking tripling in airline fares on a year-over-year basis. It was actually reported up 33% year over year. But again, if we do 18.6 over the next year, every month, that's going to compound, and it's going to compound dramatically. It's the largest 1 month rise since 1963 in airline fares. That's going to break people.
You guys remember 1963 too. That was a rough year for us.
That's going to cause people to avoid consuming. That's going to cause real growth to go negative. Medical care up 0.4%. Annualized, you're talking about 5%. So you're seeing some declines in apparel. You saw a little bit of decline in used cars, although maybe not as much as people had hoped. And you're seeing some declines in communication. But overall, the sticky inflation, especially in shelter is 33% of the overall index. And you're seeing that at well over 5%. To my mind, I think that this medical care is 7%. I mean, that's continuing to accelerate. So to my mind, I think that this inflation print, while on the surface, you could argue that inflation has peaked, I think that the tail is going to be extremely long. And that just sets the stage for more persistent Fed rate hikes, which I don't think the market will like.
Yeah, and we're seeing that reaction already in equities. Tom mentioned what's happening in fixed income. S&P futures were up, about 1%. They're now down 6 basis points. Really in the last few minutes since that announcement came out. For another data point, Dow futures have fallen about 350 points in the last. It looks like they just ran off a cliff. So they're finding some stability at essentially flat. NASDAQ futures really getting hammered. They were up strongly earlier today, down 0.5% right now. So we're definitely seeing a reaction in anticipation of additional Fed action. We heard from President Biden yesterday. He's going to speak again today. He spoke at length yesterday, essentially said that the causes of this inflationary situation are one, COVID, and two, the Putin price hike. He was pretty slow to take responsibility. He was really pressed on does your administration take responsibility for any of this? I got to say, we try to kind of walk the line on political issues. It was as weak as I've seen Biden look on a given topic. We've seen him go off script. We had the famous press conference in January where he seemed to invite Putin to invade Ukraine. But this, for a scripted release of commentary, it was frustrating to watch. His plan is basically tax hikes for millionaires and billionaires, raising corporate tax rate, use the Federal Reserve to control inflation, which it's kind of like, well, yeah, that's part of the mandate here, bud. I don't know. I thought he came off very weak. I'd welcome feedback from you guys.
I thought it came out with a man without a plan. Like he just wants to get Democrats back in office in the fall. Like that, it was a political speech. It wasn't a policy speech. It was a political speech. And unfortunately, it didn't seem like there was much of a plan. I think that, Jamie Dimon said it. We need a Marshall Plan on energy. We need to figure out supply, and the Federal Reserve can work on demand. But as long as there's no policy support to increase supply, we're just going to have to get there with demand, and that means recession.
I think the one thing that is sort of not related to what he said, but that I think is a really bad sign, was there was one reporter who basically went straight at him. It was like, what do you say about people who think you're a bumbling old idiot who has no idea what's going on? Which I can't think of a time in my lifetime where anyone has asked a question that aggressively directly to a president on TV, which I think was the most concerning piece of the whole pie. I thought I couldn't believe it. I was in my office and I could hear the TV and I was like, I can't believe this is happening. But he was like, some people have said you're a big dum-dum. What do you think about that? And I just could not believe it. I could not believe that had happened. So I don't think that bodes well. I don't think it's a good look. And it's, this whole situation is a little tough, I think.
I think the thing I'm concerned about, he put a huge emphasis on corporate tax rate. If we've learned anything on the corporate level, both as consumers and also as investors over the last year, it's that if you raise the cost of producing and selling a product, corporations will meet and surpass that increase in expenses. I don't know how that functionally really helps the situation here if we're not doing anything on the supply side. We've seen, how many companies, I think of the home builders, where they say our expenses have never been higher, neither has our margin. If you raise the tax rate, the price on products is simply going to go up. At least that's going to be the first response by corporations. And so I just don't see that as an effective strategy. Tom, thinking more about the Fed, some commentary from the Wall Street Journal. Lisa Cook wins Senate confirmation to the Federal Reserve, kind of a party line vote. Kamala Harris broke the tie. Biden did talk about kind of shoring up the Federal Reserve. What's kind of your outlook on this right now?
So we're still waiting on a couple of confirmations. There's a number of seats to be filled in. Lisa Cook, who got confirmation, I believe she's going into the Chicago Federal Reserve. She did a lot of work with the Obama administration. Most of her work, as far as I can tell, revolved around working with African nations that were having trouble economically and working on promoting women and economic opportunity for minorities. It should be interesting. She's from Milledgeville originally. I learned that this morning while making sure I had my I's dotted and T's crossed on her. I think it was always going to go on party lines. I think this is a move that probably needs to be made, and it's definitely being pushed to be made to diversify the Fed and make sure that there's, more than just, old, Ivy League white guys in there, and Janet Yellen, who's, basically that. But we still got a couple confirmations. Jay Powell still technically hasn't been confirmed. We're waiting on Philip Jefferson, who's an economist at Davidson University, to be confirmed. And so there's still a couple of seats up for grabs. So we'll see if any of those get contentious. I don't imagine they will be. I don't think people pay nearly as much attention to the Fed as they do something like the Supreme Court. So I think a lot of these will just kind of get shooed in here for the next year or so.
We do have a 10-year auction today, Tom. What are you expecting, man?
Well, let's see. Let's see where the 10-year is exactly right now, because it's been free falling since we've started this call. So we are at a 303, so we're about 10 basis points. I would expect it to be pretty weak. And the reason being, one, the bad CPI print, and two, we were significantly higher as recently as yesterday morning before the market opened. And so I think that people are thinking, hey, I could get in at a 10-year auction at 303, but I could have bought it at 315 yesterday. I think that they're probably going to be putting in pretty low bids and probably have pretty soft demand in hopes that they can get a tail on this thing and maybe get in at 310. But we'll see. There's a lot of, foreign demand is probably going to come in, a lot of opportunity here, I think, for, especially if you've been living in the European Union for a long time, where rates have been negative for, basically a decade, that, jumping on some treasuries at over a 3% on the 10-year is probably a pretty good bet. So we'll just kind of see. It's going to be, how many people in the US don't want the bonds and how many people outside the US want them. And I think the demand is going to be pretty soft, if I had to guess.
Futures continuing to just crumble. NASDAQ futures down more than 1%. S&P futures down 62 basis points. Dow futures down 40. I feel like we talked yesterday about, barring just a massive move on equities, it was probably kind of a wait and see day for the market to see what the CPI print. And I know I felt kind of like, I don't know what the print could be that would make people feel really, really good about things, at least not within the realm of possibility. At least in futures trading, people are not real optimistic. Ben, what are you expecting today?
Yeah, the core numbers, the underlying inflation is certainly more ingrained than I think even the Federal Reserve thought. And I think that you're going to see the expectation for interest rates tick up. And I don't know if we see some relief on stocks until, what's the number on work, Tom?
So we're at 2.2 for the next meeting.
What's the remainder for the year?
10.7-ish. It's moving around a little bit.
So we're at 10.7. I feel like we probably won't see some stabilization until we hit 12 on that number, which basically means we need to price in more interest rate hikes before I think that people will feel comfortable buying S&P 500.
All right, there we go. We're going to wrap it up there. We'll be back tomorrow morning at 8:30. Hope you all have a good day. We'll talk to you soon.